podcast. I'm delighted to be joined today by Paul Horsnell, Head of Commodity Research at Standard Chartered Bank, Yong He, Founder and CEO of LNG Easy, and Matthew Wright, Senior Freight Analyst at Kipler. Thanks so much, gentlemen, for joining us this morning. Paul, let's start with you. I read part of your Commodity Roadmap latest report, and you seem to be expressing some concern about oversupply. I mean, I know the market is currently oversupplied and we've got cuts in volumes, but in terms of the opaqueness, transparency on exactly how much supply is out there, both from OPEC plus and perhaps other sources, but mainly the concerns about sanctioned oil, how much volume is out there. What are your thoughts on that? Is that, do you think, going to become a bigger problem than even weak demand?
No, I'm not concerned about oversupply. I think all I was trying to point out is, all this year on this podcast and elsewhere, the talk has been about the million barrels a day difference between OPEC Secretariat views of demand and the IEA view of demand, and the entire discussion has been based is demand based. All I was pointing out was that there's also a great big gap in views on the supply side as well. And in particular, the IEA has an incredible number, 1.3 million barrels a day more supply, crude and NGLs out of OPEC plus than the US Energy Information Administration. So it isn't about OPEC and the IEA here. This is about the EIA and the EIA and the kind of alphabet soup of energy balance agencies, and that strikes me as being a very large error. I'd like to know more about, and I don't know who's right, but 1.3 million barrels a day, that's the entirety of the IEA's inferred surpluses for next year. All this talk of, it's terribly weak, the fundamentals are, it's in surplus, it rests on that. So I just wanted to move the debate on a little bit, that it's not that we don't know what the demand number is, we don't know what the supply number is either. And that makes quite a big difference in terms of overall balances. From the point of view of Standard Chartered, clearly Q3, the market was in deficit. There's been a very substantial stock draw through Q3. Whether you have these ghost barrels, the 1.3 million in the balances or not, there was still a draw through Q3. On our balances, we get another slightly smaller draw in Q4, and it's pretty balanced through the first half of next year. Now, I don't hear that being heard anywhere. Nobody's talking about the possibility that, this overwhelming consensus that the demand is weak, there's going to be a huge surplus. There's actually a debate to be had on the numbers and on the economic prospects. And I think we sort of shrunk down to the point where we're sort of taking things for granted that aren't necessarily true. And the demand is unusually weak. It's coming out roughly in terms of what we used to think of as an average sort of number for the year. For next year, think about the same. I think it's going to come out somewhere about 1.2, which is perfectly okay. So it was more of a sort of a raising the issue of what we don't know on the supply side, just to point out that, maybe we need to look at these numbers a little bit more carefully before the market goes into its universal consensus view that this is as bad as the global financial crisis and demand is melting down and there's huge surpluses. Can't see those surpluses, and I also think OPEC Plus has enough control over the market to stop those surpluses from happening, even if they were going to happen. So that was roughly the point of it, but certainly not suggesting that the market's oversupplied, quite the reverse.
Okay, all right, thanks, Paul. Well, given that, I mean, Matt, let me go to you. Obviously we have this overarching sort of bearish sentiment at the moment, and of course the geopolitics lending support now and then, but certainly without that uncertainty factor, everyone's saying prices would be lower because of this sort of bearish sentiment of enough supply and weak demand. But we have seen low inventories, that those are kind of being drawn. And do you think is the sentiment perhaps that we will see a stronger picture come Q1? Of course, it all depends on what supply comes onto the market, but is that sort of a low inventory, I suppose, or higher draws in the last few weeks lending any support? I don't see that in the price.
Yeah, good morning. It's a good question. I think when you look at sort of the key areas that the market's focusing on, and actually that you had a poll, I think, the other day, which looks at, Chinese economic data. So what's the Chinese stimulus going to do? OPEC production, the geopolitical threat, the threat of a broader conflict in the Middle East. And I'd also add into that US economic data. Now, when you look at all of them, it's the Chinese one is the main demand one. That's the main demand factor. Everything else is fundamentally on the supply, with the exception of the US. So, and the thing is, we don't know a lot about them. We don't know what the Chinese stimulus package is going to look like, and it really matters not just the size of it, but how it's applied, like where it's applied within their economy. Because, I'm no economist, but when I speak to my economist colleagues, if they put a lot into industry and manufacturing, that's good, but it's not necessarily as good as sort of boosting domestic consumption, which is what we need to see, a rebalancing of the domestic consumption, to see more oil demand, and to see their economy sort of level off in a way that is going to, in the longer term, produce more oil demand. And then the Middle East conflict, we just don't know at the moment how Israel might retaliate, what Iran's actions might be next. So I think looking to Q1, if you look on the fundamentals, I defer to Paul more on this matter, but I think we're not. I don't think we're moving into a more bullish phase at all. I think my focus is obviously on the freight side, so I'm looking to see, are we going to be seeing more seaborne volumes, which is not necessarily the perfect barometer for the market more broadly, but I'm not particularly bullish. I'm expecting it to be a fairly damp squib of a Q4 in terms of oil and water, and that's not bad. That's just more relative to where we've been before. So very long-winded way of saying there's just too much we don't know.
Okay, great. So it's a lot of I mean, we don't know exact volumes, and the demand forecasts obviously have varied as well, but are inching a bit closer together as the year comes to an end, and the China reality hitting home, I suppose, and delivering the data that we can have access to. Yong-Hae, good morning. Good to have you with us again. Let's talk a bit about LNG. We have one article in our bulletin today about Japan reinforcing its sort of long-term, I suppose, supply of LNG. It's got plenty of contracted LNG at the moment, but there seems to be a bit of nervousness about securing that, for the next few years. Is that the impression that you get, or I had the impression that Japan had a bit too much on LNG on its books.
Yeah, so I think we are all learning a bit about framing something, how you shape a narrative. I agree with you. Japan has too much LNG. There are two nuclear plants reopening this year. One in November, one in December, and the new prime minister in Japan said that he will go, full gear on nuclear, which is, I think the scientifically proven thing to do. I think Japan's ambition is to become a reseller, because they had a very large fleet of LNG ships. They know the infrastructure and so on. So they want to buy and resell to developing Asia. That's kind of what it boils down to. So I won't be reading too much into the energy security aspect, because I mean it's a silly argument, to be honest. For example, if you think about Taiwan, they're switching off nuclear and then going to LNG, what security does that bring? It's a nuclear, you're not dependent on anybody. LNG, you're depending on passage of your LNG carriers to be able to discharge in an LNG terminal. So I think that's really an overblown argument. I would say that Japan wants to make money from whatever they already have in terms of know-how, expertise, and assets.
What about China, Yong? Just staying with you on the LNG front. A lot of talk these days about China's electrification. We have an article on it today in the news bulletin. Heavy transport, LNGs on the rise, impacting its diesel consumption, etc. Is that something that we should be paying more attention to from an oil consumption point of view? Should OPEC be worried?
Well, I think recently there's a lot of attention on LNG as a long-range fuel. But it is not really something that is new. It's at least 10 years already. They built up a fleet of more than 500,000 LNG fuel trucks. And if you count about 25 tons per truck per year, it's a massive amount of LNG. So, but they had been building that up for over the 10 years. And then, so that's one point. And the second point is actually that the anecdotal evidence from China suggests that the rapid conversion from diesel to LNG is coming to an end. And there's a risk that is being reversed because basically this is a pure fuel switching game. You have the heat value equivalent between LNG and crude oil is about 16% of crude. So, and at the moment, LNG is being sold, spot LNG is being sold at 18% of crude, of Brent. So by the time you bring the LNG into a terminal, you pay the terminal charge, and then you have to break bulk because you need to load the LNG into trucks, and then the trucks would go to the 4,000 LNG fueling stations, and then they discharge the LNG cargo into the storage tanks of these refueling stations, and then the trucks can come to fetch them, right? So this whole process costs a lot of money. So basically, actually, diesel is about 25% of Brent on a slope basis. So, we are almost at parity, and some areas of China, LNG is now more expensive than diesel.
Wow.
So, I mean, I hate to break that to you, but, the whole world is saying that that's the way we're going. But
Yeah.
anecdotal evidence is actually that, in the past 1 month, it's everybody, there's a lot of issues with that.
Yeah. Okay. Well, that's music to oil producers' ears, I suppose. Thanks for that, Yong. Paul, back to you. Let's talk a bit about, I mean, sticking maybe to the China demand angle, economy angle, but commodities. Again, we have a bulletin news article today about iron falling like lead. Commodities in general, outlook. How would you say the second half has performed so far? Given obviously that China also has a lot of influence on that, both from a production and consumption point of view. What does that indicate, and what's the outlook for commodities as we go forward? I mean, given that we're in a geopolitical nervous period, we don't see, gold's been showing us a bit of sort of hedging, but we don't see any rush to support commodities or oil in general. Is that again a China demand factor?
Well, I think you normally expect that copper is the commodity which normally would be seen as the bellwether for China news and China data, and I think it's been instructive that over the past few months, financial funds and speculative positioning on copper has been pretty neutral. So I don't actually believe the oil price being affected by China demand sort of theory. I mean, the speculators have gone short for other reasons. If they wanted to just be short China, then they would have been shorting copper and the other base metals far more aggressively than they have been. And remember, for most base metals, China is about 50% of the market, half of the entire market. In oil, China demand is 15 or 16% of the total market at the increment. I'm obviously not going to say China doesn't matter, it matters a lot, but it matters far less in oil than it does in copper and the base metals. And yet all the concentration on weak China demand has gone into the oil market. So something doesn't add up there. And I suspect that the shorting of oil isn't actually really China demand. It's very much, as Matt mentioned, it's related to overall macro issues. It's as much related to the US economy, and fears of hard landing in the US maybe had a bigger impact on sentiment than fears in China. China's just a sort of, it's whenever prices are falling, it's because the market knows that demand's weak in China. And I'm not certain it necessarily works like that. I think it's much more top-down related. But on China itself, within Standard Chartered, we still see a slowing of the economy, looking for 4.5% GDP growth in 2025, 4.3% in 2026, a gradual slowing down. And I think the point being made on that is that, you know, if you offered most governments 4.5% growth next year, they'd be very happy indeed. It's not a slow number. And the talk and the way that sentiment is looking at trend in oil is as if it's going into a financial crisis. If GDP is going negative, if demand is falling, all that's happening is that GDP is decelerating down. You know, oil demand growth, it's still doing 300,000, 400,000 across the year as a whole. No, it's doing its bit. It's roughly, I think, as anticipated. But we can only ever seem to, from a market perspective, look at China in these binary terms. It's either massively booming and demand so high that we can't possibly satisfy it, or it's collapsing and demand's coming off and it's creating a, you know, so there is a middle way. And I think on China, you know, the truth is, oh, it's settling down. It's perfectly all right. The government's capable of handling those extreme risks. And in reality, I think on China demand, both the upside and the downside risks to, you know, more extreme GDP outcomes have been greatly reduced. The metals markets have taken the stimulus program, I think, much more bullishly or much more reassured than the oil market has been. But again, I think that's just more evidence that the oil market perhaps isn't about China. This is something that we're sort of feeding into it ex post as an explanation for falling prices, when, you know, actually there's other stuff going on, and a lot of it is to do with speculators and technicals and macros and
technicals and macros. Yeah, and the macro picture. Thanks, Paul. I mean, back, Matt, to you. Let's in terms of macro, you mentioned a few things at the top of the hour, and uncertainty, of course, on the economic front. But let me ask you a bit about what shipping is indicating also for us about oil on the water, whether it's refined products or crude. We've got a headline saying IEA cuts global refinery runs forecasts on poor margins. We have had poor margins and obviously oversupply as well to an extent. What are the indicators now as we're firmly sort of into Q4 on that front? And, you know, where are shipping rates going also in the context of any geopolitical sort of disturbance?
Yeah. So where we are at the moment, we're sort of rates are across the tanker market in general are increasing broadly through October, and that is very seasonal. That's very typical for this time of year. We're coming off quite a low period in the summer, so rates were particularly weak. A lot of that just primarily due to very, very low Chinese crude imports, which really hit flows early, you know, through July, August. So we're coming back. You know, rates are, so also just for the wider perspective, rates are still very high by the perspective of pre the Russian invasion of Ukraine. So we've still got that premium in the market. A lot of the premium in the market from the Red Sea crisis has dissipated to an extent. So we saw rates rocket across almost all vessel sectors from, you know, through January through to April. A lot of that has been lost, and that is now, you know, we normally see a bit of a lull over the summer period, but that was far larger than usual. You know, the market really has absorbed that entirely. You know, there's been no real change in terms of the fundamentals there. We're still seeing very, you know, significantly reduced volumes through these the Bab el-Mandeb Strait. Pardon me. So there's been no massive change there, but the market has adapted. So they're trying to be less reliant on it by sourcing crude either within the east or within the west. But yeah, we're moving into the winter. We're going to continue to see rates increase, but that is not necessarily a reflection of a stronger market, more seasonal trends.
Okay, and I mean, in terms of the yo-yo of, you know, will Israel strike Iran's oil infrastructure? Will it not? You know. Has the market now got a strong belief that that's not going to happen?
I don't know. You know, I think that if you look at what's happening on Carg Island, where Iran exports most of its oil at the moment, exports in the last week have dropped quite significantly. So there were reports earlier last week that a lot of the Iranian fleet, the NITC fleet, moved away from the area. A lot of them were empty, they were ballast. So they're very important because Iran uses a combination of their own fleet and the dark fleet, which are vessels that are deciding to willingly break sanctions to load from Iran. And while the dark fleet is very, very important, the Iranian fleet is the fleet that primarily loads from the facilities in Iran. They will then take those cargoes and pass them on to another vessel at some other point in the voyage. So the movement of those vessels is very important because if they're not in position to load cargoes, there's nothing leaving Iran. And so there's nothing else for anything else to do. And so we have looking at Kepler data for the last week, it does show a reduction in Iranian volumes. Now, the issue is a lot of this is done without AIS. So there's always a bit of a lag in terms of working out what's happening. And often you don't see an Iranian cargo until it's arrived at a country, and then we're able to reverse calculate what that cargo is. So, take that with a pinch of salt. In terms of what the community thinks, I think, the amount of, the situation in the Middle East is entirely unpredictable. And I think it would be, nobody would want to make a claim that they think that either Iran or Israel are not going to continue to strike each other.
Yeah, and I mean, putting aside the strikes and the sort of the military action, I suppose we have post-US election in less than a month, we'll have possibly Trump back in the seat, unfortunately. And then we've got a whole other sanctions outlook, don't we, with regards to Russia and Iran. And of course, that could start. And we had even, I think, the Biden administration came out a few days ago with some kind of new restriction or stronger words on some Iranian oil leaving and China getting nervous, apparently, etc. But we'll wait and see how that pans out. Before I go back to you, Yong, there's our survey question for today. Oversupply might become more of a concern than weak demand next year. I mean, I know they're related, obviously, but the whole demand story has been the talk, if you like, of the last few months. And of course, we wait to see what OPEC does in December onwards into next year. So agree or disagree? Is oversupply going to become a factor? Meaning, could we see OPEC volumes come back and then the market share battle conversation take off a little bit more? Agree or disagree? Yong, back to you. You mentioned, I just want to get back to you on the Japan nuclear stations, because you mentioned that obviously there's a plan in the works to get a lot of those back up and running. Where are we on that front? Because I know a few months ago, it started the process, but there was a bit of opposition domestically to that from a sort of safety point of view. So how is that progressing, that plan?
Well, before Fukushima, there were 33, I believe, active nuclear power plants. Now, I think they had reactivated, 13, if I'm not mistaken. So there will be 2 more that would bring it to 15. I think we are far away from the full activation, let alone building new ones. So yeah, I mean, there's plenty of scope for growth. So if you allowed, I can say a bit more about the trucking side, because I think it has more implications on other businesses as well of LNG. But anyway, that's up to you.
Yeah, no, please do. Yeah.
Yeah. So basically, I think another very big growth area for LNG is the bunkering of ships, international bunkering. So Singapore, we had it is forecast that we'll go to 400,000 ton a year. So that's a big increase of last year. And then we had very rosy the predictions of LNG bunkering market going to 3.5 million tons by 2035. Now, I would just put in a word of caution here, because the current pricing structure of LNG may actually hinder this progress. As I say, either you give LNG to a truck or you give LNG to a ship. It's by nature retail business, and retail business works on the principle of heat parity. So they switch at will. A ship owner, the normal rule of thumb of bunkering is like, LNG should be priced at 115% of we are, very ultra low sulfur fuel oil, VLSFO.
Yeah.
Now, crude prices are dropping. Some people are saying that, we may drop to $65. I don't know whether it's true, but, let's assume it is. And then with a spot LNG price at 18% of Brent, it would only increase if, you had a compression of oil price, and then you had a expansion of oil slope for, the retail fuel, that is LNG. So, I think, the current pricing model for LNG is really not so conducive for the growth in the retail LNG market, both for ships and for trucks. But if you buy LNG on a long-term basis, let's say the latest contract is 11.2%, you'll always be able to sell because, as I say, you are below the 16% heat parity. But you buy anything above the heat parity and 19%, 18%, 20%, 21%, you're going to suffocate the retail business. And that's the point that I would like to make for the LNG industry in the world. There's a watch out. We should not be very complacent that LNG will replace oil, because it may not.
Okay, thanks for that, Young. That's great to have that insight, actually. Paul, just back to you on that front. I mean, Young mentioned, well, if oil goes to 65, and just back to your point about, we were talking about commodities in general, but the shorts on oil in the market that have been quite sort of aggressive, I suppose, in the last few months. There's some commentators saying that's slowing down a bit. But what will it take? What price will it take for the longs to come back in? Will we have to go as low as 65, or we have to go lower? What would you say is the next sort of technical trigger point that the market might be talking about?
Well, I think you can see we're in a period of, if you like, it's a rinse and repeat cycle in terms of money flows, and that's reflected in prices. I mean, we're halfway through this month, and in just half a month, we start 1st October, traded a little bit intraday below 70 for Brent, risen all the way up to above 81 for a couple of days, and then back but below, well, at the lows below 73.50. All of that within 2 weeks. I think really what's going on there is that the underlying speculative, most of the faster money, I don't think anything has changed in their views at all. They're ultra bearish about the world as a whole. They are looking for, perhaps for US hard landings. They see any rise in prices, subject to the nature of the geopolitical headlines, as just another opportunity to fade the rally. But as part of that extra volatility, there are points where there have been some short covering rallies, and then the shorts pile back in again. So in that sense, I don't think anything has changed. I don't think there is actually a group of longs out there waiting for a price. If anything, we're pushing back down into that sort of dangerous area where more technical constructs like gamma hedging become an issue. Gamma hedging is, if you like, the legacy of the optionality that banks have given to producers in terms of their hedging programs. And at some point, as prices move through some critical areas, the banks find themselves having to sell oil just to cover their own risks on those producer optionality. And we're pretty close to that area. It's the largest part of that optionality is round about 65 through to 67 for WTI. We've been trading, a little bit above that to the point where those effects come through. So it could be, you can get downdrafts and the falling knife situation, you could call it, which takes us below. And I think most of the people looking who are more positive will be, sitting this out.
Yeah.
And they know that you don't start charging in when there's gamma effects in. But overall, still overwhelmingly negative. I'd say the geopolitical analysis involved in market sentiment is virtually zero. Another kind of rinse and repeat. I mean, the only thing that's really interesting the market is if there's some apocalyptic attack, and it has to be on Iranian energy infrastructure, and it has to happen in the next 24 hours. I don't think there's any analysis any deeper than that going on. It's very, very sort of limited. Right. So we're into these kind of cycles where traders wake up mornings, oh, look, there hasn't been an attack, right, let's take off some more, let's go short and shorter. then there'll be some headline that knocks those shorts out
everything
and
up
back into this rinse and repeat cycle, and we go up again. And I think we're stuck in that until perhaps until we get past the US election or there is a resolution in the Middle East. But remember, Israel is not working on a 24-hour time span. This is a much longer process, and this is potentially more of a watershed. But the market is just pricing in a series of tit for tats as if that was the major game. I don't think it is. I don't think it's a very sophisticated analysis that's reflected in the price at the moment.
Thanks, Paul. Well, there's our 73% so far in terms of, yes, oversupply might become more of a concern than the demand weakness. Matt, I'll just go back to you to close up for us today and just back onto the macro point, just to rack your brains a bit about Europe in the sense of, going into winter. I mean, in the last couple of years, we've had mild winters, but at one point post-Russia invasion of Ukraine, the US LNG sort of saved Europe to an extent. It bought, it could afford it more. China didn't have as much demand, so that helped. What's the outlook, do you think, ahead for Europe and sort of gas imports, if you like? More of the same like last year? How might that be impacting, ships coming from the Atlantic?
Yeah, exactly. I think Europe's been pretty lucky, really, over the last couple of years. They've had mild winters. They've been, restocking heavily over the summer period, and I think this year's the same. It really comes down to what sort of winter we have. If we have a cold winter, and I think I might be mistaken, but I think there's some, the long-term forecast, as much stock as you can put in them, suggest it could be a cold winter in Europe. That would cause a shock to the system and would result in those incredibly high LNG freight rates that we've seen over previous winters.
Okay, thanks very much for that, Matt. Thank you, Paul and Yong, for joining us today. Have a great sort of day ahead and remainder of the week. We've got our halftime talk feature interview coming up in an hour with Ellen Wald, talking all things of Saudi. She's talking about Saudi Arabia and what price it might be able to accept if it goes into sort of adding more volumes and more insight there on the US oil industry as well. So well worth watching. Thanks so much, everyone. Have a great day.
Thank you.
Thank you.
All the best.
Thank you so much. Bye.